Hey everybody, today, welcome to the real estate show, the Anthony Butera Team. Jason Mancuso here. Today we're joined by Steve Bentivegna. Welcome.
What's happening?
It's been a while, right? You've
Yeah.
done this before.
Wow, yeah.
Steve's a vet of the team. We talking Bills or no? Skip it?
Nah, skip it.
That was a tough one.
Yeah.
Onward. Things are looking good though. We got a topic today. I think it's pretty relative. I think it's something that's not often thought of. In that, like we talk about this market being so high, home values going up, everything's great. What does that mean if you're just in your forever home, not looking to sell, right?
Yeah, there might be some options for you.
Right. So, 5 things to do with the equity or the increased equity of recent in your home that you're sitting on if you're a homeowner. I mean, essentially, like, you could make an argument even if you bought your home last year, value may have gone up.
Probably.
Therefore, you have equity. I mean, it's important. Let's define equity first as whatever your home is valued at, less what you owe against it, which would commonly be a mortgage.
Sure.
So if your home is worth $200,000 and you owe $100,000, you have $100,000 in equity,
Exactly.
right? The, what's my home worth is kind of like
Yeah.
floating,
Right. And market value and appraised value are two different things.
Correct,
So
yep.
we'll get into, what we're
touch
doing
on
with the
that.
money.
Touch on that because that's an important thing. I mean, what's the difference between market value and what's the difference between appraised value?
Yeah, well, I mean, market value is going to be what you could get if you went to market and you sold the house. A lot of times the appraised value does line up with the market value, especially when you're selling your house on the market and there's a contract to somewhat validate your
Right.
your price.
Right.
But when you're refinancing or pulling a HELOC or some of the things we're going to talk about here, the banks are generally a little bit more strict or conservative, so to speak. So those numbers might be lower than if you were on the market and sold. So
Well, they're going to get an appraisal done by a professional in that industry.
that works for the bank.
Correct.
Right.
So, generally speaking, not to bash appraisers at all, but it's, appraisers, if there's a contract for a sale at, whatever number, they're going to do what they can to try to make it work, just to not crush dreams or
Well, yeah.
halt the economy type of thing,
There's
I mean,
something to be said.
there's, don't get me wrong, it's not like a shady thing, right?
No.
But it's just, if a buyer's willing to pay something, if you have all the evidence of all these backup offers and everything else, and all the homes are selling like hotcakes, then, it's tough for any independent appraiser to be like, no, this home isn't worth that.
Right. You got 10 people willing to pay it.
It's there in extreme examples where, if a buyer is just going above and beyond and the appraiser can't just justify the price that they're willing to pay, they're protected in a way, or the bank is protected,
Right,
really.
right.
With a refinance or anything that you're, some of the stuff we're talking about, trying to pull equity out of a home, I mean, again, hate to disparage banks or appraisers, but like, it's a different game. Ultimately, the bank wants to limit their risk. So these appraisers know, like, okay, I'm not going to give it the, top end number that it could potentially be.
You can't really blame them.
Yeah, no, I get it.
They need to protect themselves, yeah.
I've done this on my house, and like I was, as an agent, meeting the appraiser at my house, I'm like, look, this is what I would do to sell this house.
Yeah. And we'd sell it for more.
Yeah, and here's where I'd list it at, here's where I'd expect to sell it at, and the number she came up with was obnoxiously low. But
Yeah.
whatever, it's cool. So that's an important kind of like definition to get things started of just like, what is equity? How do appraisals work? What's the difference between that and, market value? I mean, you can, we'll get into it, but you can just, you don't have to get an appraisal either if you're not, one of the examples in what we're going to talk about doesn't require any work. And it's just like, okay, if you feel your house is worth $250, then you can kind of, make this up for example's sake too,
Sure.
just based on what the market's doing. You have beautiful hair. I don't want this to come across bad in a video. You got a little pat down to do. There you go.
Kind of tough with these things.
Friggin' jealous.
I know.
All right, so this isn't like a top 5 in order. This is just 5 things to do with equity in your home, right? So in no particular order. And again, I hate to speak from personal experience, but the first one is something I just did recently too. PMI was private mortgage insurance. If you buy your home and you get a mortgage and you don't use a 20% down payment, you're going to have to pay PMI. I'll get personal and tell you like my mortgage was $150,000, something like that. We didn't do 20% down. We had PMI. I think it was like $60 a month. Okay.
Well, yeah, I mean, I think it's different for everybody.
Yeah, there's no.
It could be more than that.
Yeah, exactly. There's not a set, or I'm sure that, they have the calculation, but it's a variable amount.
I've seen well over 100.
Yeah. Point being is like, 50, 60, $100 a month. That adds up over time. And
30 years could be.
right. Well, so important to establish, and this is, we got to have this conversation. I'll do the cover my ass statement, right now. If you're looking to take advantage of any of these options, consult with your accountant, consult with a financial advisor, get with a banker. We're realtors. We're not, in that business of giving financial advice.
Right. Just an overview.
Yeah, exactly. So this recently changed the last few years. If you have an FHA loan, PMI now never goes away.
Forever.
If you have a conventional loan, it would go away once you reach a 20% equity stake. So if you have a 20% down payment that you're buying the home with right off the bat, you wouldn't be subject to PMI.
Correct.
So important to know, if you're getting into an FHA home or an FHA loan to buy your home and you're planning on this being the forever home, then that's never going to go away. Account for that, whatever it is, $60 a month till you pay off your mortgage.
Right. Yeah. I have that conversation with people all the time. I mean,
Sure.
If you're thinking, well, do you want to go FHA or conventional? And generally FHA, you get a lower interest rate, right? But I think it's pretty nominal.
Yeah, I mean,
So
everything's
it adds
variable in that conversation, right? Yeah.
And then the other part of the question is, well, how long are you going to live there?
Right.
Because if you're going to live there for 30 years, and you're either going to want to refinance down the road, maybe, or consider another option.
Right, and generally, most FHA home buyers, it's not their forever home. I mean, tough to really say generally, but I would, if we had data on that, I would bet that the majority do not.
What
right?
did I say, 7 years?
Vast majority, yeah. So, So, understanding that, you may not hit that 20, well, it's not going to go away with an FHA loan. Mm-hmm. So it's going to stick there even if you have more than 20% equity. If you're there for 7 years, you're paying, 12 times 60, 720 times 7. It's a good chunk of change. We're talking about actual money here. So here's what you do. If you've owned your home for a short term, like let's say you bought your home 3 years ago, did a 5% down payment, you would want to, first, this is where you can consult with us to kind of get some base numbers to see like, hey, here's what I paid for my home. Here's what I owe on my mortgage. What do you think the value would be for an appraisal if I did one? And we can let you know it could be this. What's happened with the recent spike or gain in home values everywhere is that you may have 20% equity without even really knowing it. Mm-hmm. And therefore you can approach your bank to say, hey, I want to see if I can drop the PMI because I should have 20% equity at this point, and I've got a conventional loan product, and that should go away, right? Mm-hmm. Again, fine print, every loan program.
There's other fees.
You got to figure things out. This is issuing kind of a blanket idea or a statement. Everything comes down to the individual loan that you have and how it's structured and what the fine print is. But this worked for me personally to where I paid, $400, I think, for an appraisal. They came out, appraised it. I had 20% equity. more than it, right? So PMI drops off. Now saving myself $60 a month moving forward.
Right.
Forever.
Sure.
Versus if you don't do this, essentially, like, you know, I don't know that it happens automatically, but you're going to have to track, like, okay, what's my loan payoff? What did I pay for the house? Is the old way of doing it, is my understanding. Like, well, what'd you pay for the house? What's your loan payoff? Once that reaches, you know, a 20% margin, you're eligible for the PMI to drop off.
Yeah, I mean, I would, at that point, if it makes sense, like you said, you consult us, we kind of figure out if there might be that kind of equity, and then we're going to point you in the right direction to make sure that that works for you,
Yep.
and that that's the proper.
And ultimately, we have to, you know, start and end the advice with get with your lender. I mean, on this topic, there's not much of an accounting risk or anything like that.
No,
But
yeah,
just
yeah.
get with your lender, see if your loan can allow for it. It's if you've purchased your home in the short term within a couple years, and again, arguably maybe
Well, in
even
this
last
market,
year
yeah.
in this
Right,
market,
yeah.
it's worth looking into this.
Yeah, for
because think about it this way too. Like, say you did a 10% down payment. It's not
Just a
unheard
year
of
ago,
to
you're
say
probably there, yeah.
that, you know, home increase or home value increased 10% over the last year, 18 months or 2 years.
Yeah,
You're there versus just paying, you know, again, keep in mind your mortgage is structured to where you're not paying principal anytime. I mean, you're paying a little bit over the short term, you know, start of the loan, right?
on a 30-year especially.
Yeah. So, you know, it takes time to get to the point where, you know, the bank starts chunking down your principal amount versus taking all the interest up front in the first, you know, however many years of the loan. So it's going to take a while for you to just, I guess, organically reach
it off,
20%
yeah, right.
and have that principal paid down to where it would be there.
Yeah, that's a good point.
Not many people, you know, think this way, right? So,
Well, I would suggest everybody look at an amortization chart
Right.
and see
Yeah,
what you're
it's-
paying on interest.
or
and
don't because
principal.
it's friggin'
Yeah,
depressing, but
yeah.
yeah, you know.
Might switch you from a 30 to a 15. But.
Right, but you know, here's a trick to save. You know, again, could be 60, could be
Sure.
100, whatever it is,
Yeah.
and it's like it's easy enough. You know, especially this is you know, a lot of this conversation is a symptom of the market right now.
Sure.
So there's one thing. Good to move on. Anything to add?
Yeah, no.
Cool. Next two are getting loans from the equity that you have in your house. So two different home equity loan products that are common. One would just be a straight home equity loan.
Like a refi.
Well, yeah, that'll be another thing. But you know, just think of it. You know, again, that example: your house is worth 200, you owe 100, you've got $100,000 worth of equity. Most banks will lend up to, and some are more. Some, you know, ESL locally does 90%.
On a refi or on a home?
On a home equity or a home equity line of credit, which we'll talk about next. But just a home equity loan. In that example, say you can get 80% of the equity in your home. That example, 200 less 100, you have $100,000 of equity. 80% of that, $80,000. You can get a loan and have that $80,000 deposited, you know, in the form of cash into your bank account, and now you're paying off another loan. It's almost like having it's not a refi, but it's, you know, having an additional loan that you have monthly payments for until it's paid off.
Gotcha.
So, you know, if you have a kitchen remodel or, you know, something big that you need to, you know, go spend a bunch of money on that you don't have liquid cash, here's an opportunity to tap into the equity of your home to, you know, take advantage of it. Keep in mind the monthly payment, keep in mind more interest. You know, this is where, like, okay, it may make sense to get with, you know, or not make sense. I would recommend get with your accountant, get with your financial advisor. Does this make sense to utilize?
And you're borrowing the money. The money goes into your
it's
account.
not free.
Yeah. Yeah, you're paying interest even if you don't use it, which is different than the next option, right? So-
Correct, yeah. So home equity loan, you get the money. You know, I'm trying to think. I may be wrong here, but I think the fine print of these documents will refer to like using the money for your home, or an improvement or a repair.
I think there's multiple products.
Right. True. In theory, you got 80 grand. If you're heading to Tijuana with it, knock yourself out.
Yeah, good luck.
Right. Just pay, understand you're going to have to pay that off.
Yeah.
And it's going to be a higher interest, shorter term than your 30-year mortgage. So, it's an option to get cash without, using your liquid cash or, tapping into, retirement savings and getting penalized, stuff like that. Just, again, wrap your head around the financial aspects of it with the interest, with the additional monthly payment, stuff like that. Mm-hmm. In the same breath, but different product, is a home equity line of credit, which, HELOC, home equity line of credit, HELOC, right? This is same concept as the home equity loan, but you don't have to use it. Like, you get a line of credit, essentially think of it as a credit card with, in that example of the numbers we ran through, an $80,000 spending limit.
Yeah, right. And you're only paying interest on what you use. So
Correct.
If you have 80,000 in that line and you're only using 20, you're paying interest on the 20, not the full 80, which is going to be the difference.
Till it's paid off. Versus option before that was like you got the money, you're paying interest on all of it till you pay it off. This is you pay as you go type of thing. It's it's a line of credit. It's a credit card, whatever you want, however you want to think of it. But it's I guess that pay as you go concept, right?
Yeah.
So
now, I'm more familiar with those with the regarding the terms, and I know those are real common to be like an 85% or 90% equity is what they offer. But it's a little deceiving the way that they say that. So. To give you an example, if your house appraises for 200 and you owe 150, 90% of that 50,000 in equity would be 45,000, right? You would think that that's what you get, but actually, if it appraises at 200, what they're going to do is they're going to take 90% of that 200, which is 180, and then they're going to subtract what you owe, which is 150, which leaves you with 30. Right. So 45 compared to 30 is 33% less. So I mean, keep that in mind.
Yeah.
If you have more equity, it's not as drastic.
And this is where you got to shop around, right? Because it's not, different banks will do different things.
Yeah.
So you make a good point. You may be able to achieve, the opposite of that too. But I mean, that's a great point. To me, and again, not giving financial advice, if I'm anybody who's been a homeowner for more than 3 years or potentially even shorter than that, I would look into this because, it shouldn't cost you much, if anything at all.
I don't think most banks don't charge. They do
I
the
just did it.
appraisal on the house.
I had to deposit $1 into a bank account. Okay? Yeah. Open a new account and then deposit whatever you want.
Now the money's available if you need it.
It's an emergency fund, if nothing else.
Right.
Okay? Sure. So, like, if you got, whatever, you're remodeling, you got a project, you got expenses coming up, it's a great option to have that, tap into the equity of your home in the form of another credit card, essentially.
Yeah.
But you don't have to use it. So, if nothing else, and this is where consult with a financial advisor. If there's some other risk that we're not talking about or not aware of that would cause you not to do this, okay, so find that out before you just go and establish a rainy day fund. But that's the way I'm thinking about this, is even if you don't need the money, your home is worth more than it ever has been, probably. Mm-hmm. You have more equity than you ever have had, most likely. Here's an option that you can just set yourself up to where if shit hits the fan, that you at least have this sitting there and you can, use it if needed. If you're doing a remodel or whatever, and you're using that to pay the bills and then paying it down, so because you don't want the interest to rack up.
Sure,
that's an option too.
Yeah, I have a lot of clients that use that home equity line to write offers on investment properties.
As cash, right?
Cash offers. Yeah. So maybe something that doesn't qualify for a mortgage, you can pay cash for it. generally speaking, these home equity lines at a slightly higher interest rate, right? So
Yeah, it's like, don't get me wrong, everything we're talking about, we'll get to the next one that won't be in this conversation, but you don't want to be paying short-term interest for long-term.
right, exactly.
The goal is to, okay, you use it, you take advantage of it by, again, I think the common example would be like not tapping into your 401k and being penalized for it, right? To get cash.
Yeah.
But, from there, like, you don't want to just have a 30-year term built up over, it's not even going to be allowed, but, over some home equity loan. Because that's going to not make financial sense right there. Without giving financial advice, I can tell you that's not a great position to be in, right? So,
well, like you said, I mean, it's not a one-size-fit-all. That's why there's all these different products, and depending on what you're looking to accomplish and what your goals are, they're good tools, but one may work better for me than for you.
Correct.
And the other way around.
Yep, exactly. No, I think, this conversation being, the caveat to it, like you said, is that there isn't one size fits all. You gotta, figure out what makes sense for you is
It's
key.
the beauty of real estate. There's so many different ways to do it.
But you make a good point in terms of like this line of credit now being, you can then, we're going to talk about this in the last point is, you're able to potentially go make other investments with it if you want.
Yeah.
It doesn't have to just be for, remodeling a kitchen or a bathroom or putting a roof on your house or whatever it is.
Buy an investment property, fix it up, and then refinance it into a 30-year, longer term, lower interest rate type of thing. Pay back your home equity or whatever. There's different options.
So that goes to the next point of, you mentioned it earlier, but just a straight, you're taking your mortgage and you're refinancing.
Oh, okay.
Okay. So, equity allows you to refinance is one principle I would say is in play. Even though rates are on the rise and have risen, if you bought your home 10 years ago or, I don't know, pulling the dates, but I mean, say longer than 5 years, you're probably still at a higher interest rate than what you could even get now. Now, these lenders have just seen a gold rush of sorts with their business with all these refis that have been done over the last couple of years because people are looking at it from the standpoint of saying, okay, wow, I can refinance to a 15-year term when I've got 20 left now, and I'm going from a 5% interest rate to a 2 point whatever it was last year, right? And like, okay, wow, I just shaved 5 years off my term.
Yeah.
I'm paying less per month. Why wouldn't I do that?
Are you asking me? Because there are reasons. There are reasons why you wouldn't do it. But in the typical situation, and if you plan on living in that house for a long time, if you're moving next year, it might not make sense.
Correct.
Because you're going to pay closing costs.
Correct.
And where you are in the loan, honestly.
Exactly.
Depending on what your goals are, what you're trying to accomplish. It's not a one size fits all.
And I wanted to touch on that. Those are excellent points in terms of like this isn't just always slam dunk decisions. You really gotta look at things and again get financial advice if you can't figure it out on your own.
It could start with us, though. I mean,
absolutely.
And then we point you in the right direction. And
we just got to cover our butts. Say, hey, we're not financial advisors, so we got to get that advice from that professional.
100%,
but
100%.
I mean, we deal with this to where we're okay with hosting a podcast on the topic. I guess putting ourselves out there.
Sure. Yeah.
Even now, in the event where your interest rate is higher than what the rate is now, there could still be opportunity to refinance and be in a good position.
Sure. Yeah.
And to your point, I would offer that, like, if you're thinking of moving anytime soon, then probably don't. But otherwise, like if you're pretty confident you're going to be in the house that you're in for a while, there may be something to take advantage of here.
If you bought a while back, yeah.
Now, equity-wise, common term is a cash-out refi. Cash out refinance. So like, if you may choose to take a higher loan than what your balance is now and get a percentage of the difference in cash that you can go do whatever with and maybe have a lower interest rate but you're starting over, essentially a new mortgage, and maybe you may have a new 30-year term if you choose to do that. You're going to
different
have a
options,
higher
yeah.
loan amount, but overall you're okay with it making sense financially because you're going to get this cash to do whatever you need to do with it, and you're happy with the rate that you have now and committed to the term of whatever you agree to.
I would recommend having a use for that money. Again, it comes down to if it's sitting in your savings account and you're paying interest on it, it probably doesn't make sense.
Paying interest on
Might
a
as well
new
have a
loan
HELOC,
and getting minimal return on a savings account.
Yeah.
Yeah, exactly.
Nothing.
Right, exactly.
Right.
So that's a good point. Bringing this all full circle would be the fifth thing. So we've done 4 so far. PMI, getting rid of that. Home equity loan, home equity line of credit, and refinancing options. Fifth thing, tying all this together, is really like making additional investments if you're in that mindset.
Sure.
Right? Or just, additional investments should add to your net worth. But just, remember that like your home is your asset, is one of your assets. For most, it's one of, if not the biggest asset that you have. So when equity is increased, your net worth increases. You're worth more on paper. Does that mean anything if you're not selling your home anytime soon and cashing out and seeing that gain? Maybe not, but like it's a
It's a safety net. If
yeah,
nothing else.
exactly, right? So just understand that what this increase in home value is doing for your life, even if you're not selling next year or this year, right? This is still an overall good situation. I think the topic that we wanted to touch on is around that. Like, hey, we talk about selling, buying all the time, right? If you're not in that category and you're happy with your home and you're going to be there forever is the plan, it's still a topic what this market's been doing for you, and you can
sure.
take advantage of it tangibly or more or less intangibly by just having your net worth increase because your asset in your home is worth more than it ever has been.
Yeah.
And depending on what you owe on it, if again, say you've owed 100 and 2 years ago your home was worth 170 and now it's worth 200, your net worth increased by 200 or 30 grand over a short term without doing anything. Right?
Yeah.
It's not, and this is an example of you haven't done anything to the house. Like, if anything, you've done nothing and it's deteriorated over time, over a couple
And
of
it's
year
still
period,
worth more.
and it's still worth more. That's an amazing aspect, right?
Yeah.
But all of these, tapping into the equity, for lack of a better term, one of the, common objectives that people have with it is to make additional investments. And you mentioned it, like, your home equity loan or line of credit, you're going to have a bank account associated with that. So that's essentially looked at as cash because it's immediately available.
Right.
It's liquid. So if you have $100,000 in that account and you're making an offer on a property, it's $90,000. You can make a cash offer if it makes sense.
Yeah.
And you can play around with it from there. And it could go, real deep to where, like you mentioned, you can buy the home with cash using your equity, cash out, refi, get cash from that, pay the equity loan down. Now you own an investment property with a mortgage at a good rate still. You're cash flowing on that. You have another asset that eventually, it has equity and will build more equity over time.
Yeah. I think the
Makes it, all full circle, right?
yeah, the theme here is that there's money to play with here that you may not have thought about,
Absolutely. Absolutely. And I mean, again, like, I don't know, I felt it was important to get this out because we talk so much about like, if you need to sell, are you looking to sell? Should you consider selling because, your home is worth more? It's not a relevant conversation for, frankly, the majority
A lot
of
of people, yeah,
right?
right.
I mean, the majority
Yeah.
of people.
Yeah.
So with that said, like, okay, how can those people take advantage of the market that we're in? Here's how.
There you go.
You have tangible examples in terms of here's what to do and how to use, what you can be left with. Or just, if nothing else, like, you're worth more. at the end of the day, right?
Yeah.
So, I don't know. What are your thoughts?
Yeah, no, I think a lot of good points, and you know, if you're interested in taking advantage of some of the equity you might have in your house, you know, reach out to us.
Yeah, we always like to be the main point of contact and
Yeah,
can
for
point
sure.
you in the right direction from there. And we'll do, we'll do the legwork to kind of give our opinion on like, hey, we know how these appraisals work, so here's, what you can expect, at
Yeah.
least a range,
And-
and then you can be able to plan from there.
Yeah, for sure.
Because before you go out and spend, 400 or whatever it is to get an appraisal done to start this process, you may as well like at least
Research
get
it a little bit. See if
Yeah,
it makes
get an
sense.
idea
Yeah.
that things are going to be confirmed and fulfilled the way you're thinking it should.
Yeah, and I would say too, don't get discouraged if you don't have $100,000 in equity.
Right.
I also see people pull equity from their house just to use as a down payment for another loan on an investment property
Sure,
or something
absolutely.
like that. So, there's a lot of different options.
Don't get into dangerous territory, though. Do understand there's interest. This isn't
there's
free
risk, yeah.
money, right? This isn't like, oh my God, free money, right? You have additional
borrowing
interest
it.
in
Yeah.
play now. So, the only, I guess, non-interest related money is if you do sell and cash out and get it, right?
Right. Yeah,
And you're
for-
moving on with your life. So, those are just proceeds at that point.
Agreed.
Yeah. I don't know. Did I miss anything? You got 5 there. I'm trying to rack my brain if there's anything else you can do with equity, but
I mean, not that I can
Covered
think
it?
of. Yeah, I think that covers it.
good deal. All right. Steve Bentivegna joining us this week. Thanks for coming on.
Yeah, my pleasure. Thanks for having me.
Check us out, AnthonyButeraTeam.com. Give us a call, 222-SOLD. Thanks for tuning in, guys.